financial contracts, be they insurance contracts, annuity contracts, or so forth, can be scaled proportionately and made available in these payout phases. In the case, Evan, where we don't have substantial assets, and there may well be a need for some kind of a lifetime payout. So it's a challenge for sure, but it's a project that we're undertaking to see if we can't bring solvency disciplines into these emerging economies such that we can sort of complete the payout phase appropriately.
No, thanks very much, Tom. And just before I go back to the panel and Beth in particular, and then for them to have a final remark, Mitch, I was going to offer you an opportunity that you also may not want to take up, but I was just struck by the conversation we had a few days ago or a couple of weeks ago on Indonesia, and sort of if you were president for the day, the way you would have built on some of the discussions we've been having today in terms of taking forward expanding coverage in a country which has got, loads of people, but lots of geographical dispersion and issues on financial inclusion and the rest of it. If you wanted to do a 2 minutes, but let me let you think for 2 minutes whilst we have the panel have some comments, and then I think that would be interesting to share.
Yeah, I just wanted to continue on the inclusive insurance and do a little plug. This morning we had a session in which we introduced this paper. Susie Cheston wrote the paper. And it really is exploring what's going on in the inclusive insurance market, and it's clear that many of the same issues on the demand side in terms of being able to convince people to participate, make it easy for them to participate, look at the administrative costs and how to reduce them to a level that it doesn't eat up all of the value. There are many of the same issues at play, and even some of the regulatory issues we see being similar. So I would just this was done in conjunction with the Institute of International Finance, and it'll be out in a few weeks.
Do you get the same kind of diversity of who's providing different bits of the product, or is it kind of university public, university private, or a mix and match?
Well, we're talking here about private insurance, and I mean, I guess the big thing, the big issue there is that how do the private insurers, it's a distribution issue, how do they connect with the customer, and the customers have other types of interactions, like Gautam just describing the customers who now have bank accounts, so they can piggyback insurance products on top of a bank account or on top of a mobile phone or on top of membership in some kind of another organization.
So Mitch, if you wanted to say anything, and then I'll ask the panel just to do sort of a closing thoughts in a minute or so.
Yeah, I also want to say some words about annuitization again, because I've looked at a couple of countries. I've specifically looked at creating annuity markets in developing countries, and the problem is, I'm an actuary, so from an actuarial point of view, price is directly related to risk, right? And to the extent that you can quantify risk well, you can price better. So when you go into let's say Macedonia, Romania, which are two countries where I looked at trying to develop a fixed income annuity market, just a regular life annuity, guaranteed income, basically it can't really work because you don't have the investment instruments of the correct duration to allow you to immunize your investment risk. So you have to be able to predict the rate of return that you use to price the annuity. To do that, there have to be financial instruments available in the country that you can purchase that have the duration. And for an annuity, it's going to be paid out over about 15 years or more. You need an instrument of 10, 12 years duration, and a lot of times you just don't have it. So you can't protect yourself against changes in interest rates. And secondly, it's very hard to predict longevity gains and even to get accurate statistics on mortality for the covered group. So if you can't get good data on mortality, if you can't predict mortality improvements, if you can't protect yourself against interest rate changes, it becomes impossible to offer that kind of a product. So the approaches that are being suggested here, I think, and the only ones that you can do is some type of a participating annuity where you take the risk and you share it directly with the participants. So you price on a conservative basis, and then based on actual experience, you can give dividends. But that requires very sophisticated regulation of the insurance market, which is, again, very difficult to achieve in an overseas market. And again, the other idea that you can try is variable annuities, but then that assumes that you've got a portfolio of investments that you can use to back the variable annuities. So, in my mind, we just need to go to some kind of a fixed payout period. It was one of the things that you suggested in your less than ideal world, where the insurance starts from age 80 and you use the savings part, on a non-life annuity basis in the early parts of the period, because I don't think you can really develop an effective annuity market, in most developing countries. It's just the data that we need to do it. So if I'm an actuary and you force me to do it, I'm going to put very high risk margins in it. By the time I do that, the product is so uncompetitive that you might as well just put your money in a bank, and earn interest on it. So, and of course, the primary reason for the bad annuity interest rates, the annuity rates, is twofold. One is we're in a low interest rate environment, right? And then it's like buying a bond, so it's negatively correlated with interest rates. So when you have a low interest rate environment, the price is going to be high and the product is not going to be as attractive as it was, for example, in the 1980s when we were selling tons of annuities, in the United States. And the second thing is the degree to which you can prevent anti-selection, where it's only the healthy people that buy it. So if you can prevent anti-selection, again, you can offer more attractive prices because you're going to get a mix of risks. So, this whole concept of annuitizing second pillar balances, I'm very skeptical. We've tried it for a lot of years. I'm very skeptical that we can really do it successfully. Now, on the financial inclusion side, quite frankly, William, I'm not sure exactly what conversation we were referencing on that. Sorry.
It was in a coffee shop rather than a bar, but it was more just the idea of that in Indonesia, because you could create the central sort of regulatory structure, but it was how you would potentially offer a pension to people who are of kind of modest means by connecting some of the dots that we're talking about today. So I may have sort of slightly stolen your thunder, but it was, and the notion that you could actually target that kind of population if you got the sort of ID and the IT right and connected it sort of centrally to things at scale. But it was challenging at that time for various reasons, so it didn't happen.
Well, yeah, I think we discussed that at length in an earlier session today, but all the pieces are there, having the national ID system, having some of the systems like, Gautam helped us out in Indonesia some years ago, having a system that allows people to make small contributions on an irregular basis, as I think Beth was discussing, and then being able to accumulate them and then deliver them to formal sector institutions in monthly chunks like they want. You need that interface because most formal institutions don't want to receive tiny little payments. So we need to let people make tiny little payments because that's what they can afford to do. And then we need some system that allows those to accumulate in like escrow accounts and then deliver them to the formal sector in monthly packets the way that they want to receive it. So all these pieces that we've been talking about, and having multiple points of service, where somebody can go into a 7-Eleven and make a contribution, or a post office, or using mobile technology. Some countries have 7, 8, 9 different points of contact, ways that you can pay into the system so that it can go into the system and not be dependent on a particular carrier, not be on a particular fund, and that it's a generic system that accepts money in and then accumulates it and delivers it where it needs to be. And it's especially important in a country like Indonesia, where we have 7,000 remote islands, and where, for someone to go to a bank or to go to the nearest town, they might have to ride on the back of a motorcycle over terrible roads for 40 kilometers to get anywhere. So that whole convenience factor of being able to do everything, which is not just the mobile technology, the mobile phone that we discussed, but many other potential technologies that allow for that. But I think we covered that pretty well, and it's the fact that all these pieces have been put together by people like the people that are in this room over the past 5 years, that where 10 years ago you would say collecting from the informal sector would have been an impossibility. But now I would say, given the technology, we sure can do it. And then another question that Gautam kind of raised over lunch is when we say, like, what billion people are we talking about on the sign? That question was asked this morning too. Saving the next billion. In my experience, when you look at what we call the informal sector, or perhaps better called the non-salaried sector, about half of them are poor and can't afford to contribute. It's those people in the middle that are probably somewhere in the 30 to 70th% on the income distribution. I think that's the billion. I don't know if billion's the right number, but that, those are the people that we're talking about here for whom these solutions are going to be effective because they have some disposable income. And if we deliver to them benefits that they really want at a price that they can afford, and if we give them a platform that makes it convenient for them to be able to make the contributions, then I think we can be successful. and we can make some real inroads.
Great, thanks very much. I just think you say it in a very nice way, so it's good to hear the kind of all the bits together. So let me just pass back to the panel, and let's, JP, you can go first because you were the last, just some concluding remarks.
Great. Well, thank you. I guess just one thought, just in hearing some of this conversation. One of the dynamics in the U.S. 401k market that struck me is that we do have the large record keepers also have a large business of providing individual retirement accounts, which is the most common really payout for 401ks. It's a lump sum that then gets rolled over to an IRA to protect the tax protected status, and that typically gets deferred to age 70 and a half when you're required to start distributing it. The tax code kind of enforces a payout structure that on top of Social Security, it may not be such a bad approach for a lot. And what we are seeing now is that larger plan sponsors are mindful of this almost incentive for their 401k record keeper to encourage or at least enable this rollover behavior, or taking more actions to keep the money in the plan and let it just continue to defer to 70 and a half in combination with a target date investment. You might get, maybe not as good an outcome in terms of protecting against longevity as a true annuity, but you get reasonable outcomes in that arrangement.
Right, I think we see a lot with the government-sponsored pension funds that are doing extremely well. Also, in the traditional pension fund countries, the state is becoming much more active, because the results of the voluntary system were not that great. The Government Accountability Office here has a report coming out, 40 years of US retirement system, and I think it will be very sobering what I heard. So it will be more active government, I believe more in public-private partnerships. Investment should be done by professionals. So the question is how to best control asset managers that they deliver the results they ought to deliver. And I think Nest does this very nicely, the whole approach. So we have a government model combined with pro-profit competitive systems. So you have the benchmark from the government and then the competition from the private sector. And up to now, this is for me a very convincing model. No, thank you.
So I'll just return to the subject of annuities, because I do think if we're delivering retirement security, we probably want to do that through retirement income, not lump sum payments. I mean, there may be reasons in a particular country where you do want to do that for whatever reason, especially for lower income people. But another thing that I don't think has been explored enough is uninsured annuity, provision of annuities through an uninsured solution, tontine type approach. Not tontine in its traditional standard sense, because that doesn't work that well, but uninsured solutions which pool longevity risk and focus on delivering income, but maybe are able to do that income at a little bit lower level because it avoids some of the regulatory issues, other issues that may be involved in delivering it through an insured mechanism. That's probably have to be delivered by the government. Oh, sorry.
Maybe just emphasize a couple of lessons from our database that's been the developed world database over the past 25 years, and that I think will be universally applicable in this environment as well. And one is the importance of scale, and the second is the importance of a value for money orientation in the design and operation of these plans.
Okay. Well, let's start with annuities. For another issue I think that comes up when you're looking at annuities in emerging markets is that the only annuities that could be provided are nominal annuities. And in countries which tend to have higher rates of inflation than maybe in the UK or Europe or US, that means that by the time the person reaches 80, they haven't got anything anyway. And they can't really have index can't inflation-linked annuities because the governments don't issue index-linked bonds, and so there are immediate challenges there. So you are forced down the phased withdrawal route as sort of the second best, or maybe the optimal solution. And there are various examples of sort of regulated phased withdrawal to make sure not too much is taken out in any one year. So Nigeria, Costa Rica have done that. But it's interesting actually in the UK, the experience with freedom and choice is where people were allowed to take all the money they wanted and spend it on a Lamborghini if they want to. Actually, not so many Lamborghinis were bought, and actually it's starting to look like phased withdrawal is becoming the popular form of investment for those with middle to larger size pots. People with very large pots still buying annuities, and people with small ones are cashing out. So it is a product that I think can actually be attractive, where people have a choice. It's not something they find too difficult. But if you're going to have that, and particularly if it's going to be run through the pension fund itself, then it's even more important that you have life cycle investing, or like a sort of target date fund investment, but beyond the target date. And that in turn, which is sort of another element of investment governance we haven't yet mentioned, because I think everyone knows by now that the life cycle approach is a necessary form of getting decent investment outcomes. I think sort of completes the picture. But of course, one other part, going back to scale, is you need a certain amount of scale to actually be able to do life cycle investing, and a certain degree of in-house capacity and a certain degree of sophistication. So it rounds the picture off.
I have just two relatively minor points that I would like to end with. One is that hasn't really been mentioned, I think, is the issue that people don't underestimate the interest that people have in preparing for their old age. And, we think that, they don't save, but it may be because they don't have good alternatives. They have many other things that hit them harder, and it's difficult to maintain discipline. But I think that when people are given the opportunity to save, they do want to do that, and they want to be helped to do that. The other thing I would just say, a very different point, is just it's interesting the extent to which there's a financial inclusion discussion, there's an inclusive insurance discussion, and there's this pensions discussion. They're very separate with different people in the room, and really there needs to be a lot more back and forth and learning from them, because there needs to be cooperation among the players in those three areas in order to put solutions together.
And that's a great way to end, because that's exactly the sort of purpose of this, and hopefully sort of many conversations to come. So can I ask you to join me in thanking the panel and moving on to the next session? Well, Well, actually, are we doing coffee and then the final session? Yes. You're free to have a break for 25 minutes. Oh, no, you're not free.